Friends, what is happening on the market right now? Whales are buying more, shorts are packed to the ceiling, liquidity is disappearing, and the chart behaves as if it's preparing for something big. Is this the feeling of a reversal or a trap before another crash? Why is the RRP empty? Why are altcoins dropping deeper than in previous cycles? And most importantly, who is right now? Those who panic or those who scoop everything at the bottom? Today we'll break down what's behind this strange calm before the storm and whether we're really facing a short squeeze or a new wave of pain. Get ready, it's going to be sharp. Before we start, this is not financial advice. Everything I talk about is my view and my subjective judgment. Use it as an additional perspective, not a call to action. Right now, the market is in a paradoxical situation. The price is falling, fear is off the charts, retail is panicking, ETF flows have been negative almost the entire month, but big players are doing the opposite. In the last few days, whales have bought billions of dollars worth of Bitcoin. These are not small purchases. These are wallets holding 1,000 BTC or more. One such wallet, at today's price, equals about $86 million, and the number of such wallets is now rising sharply. Looking at the on-chain chart, the green whale curve is turning upward again while the price goes down. This is exactly how it looked at the beginning of 2024, when Bitcoin dropped to 45,000 and the number of whale wallets suddenly increased. After that, the market climbed to 75,000 within a few months. And if you think that such wallets are not enough, then let's talk about one mad whale. A trader appeared on Deribit today who opened a long for 20,000 BTC. This is a $1.75 billion position. You don't do something like that by accident. He is betting everything on Bitcoin flying into the 100 to 118,000 zone already by December. This is not some YOLO shorter from Twitter. This is a structured call condor through Paradigm. This means his bet is thought out. He is not expecting a rocket to 200,000. He is aiming clearly at the 100 to 118,000 range, meaning he sees a rally, but not a crazy breakout. And here is the main question. Is this a new insider prophet who already knows about the upcoming short squeeze and market reversal? Or is this the craziest way to burn almost $2 billion in a Christmas fireplace? And here is the logical question. If everything is as bad as social media screams, then why are the biggest players calmly taking coins off the market? History shows a very simple pattern. Whales buy during moments of maximum fear. And they sell when the market is euphoric at the highs. That's why whale behavior now doesn't match retail panic. The second powerful factor is margin positions. During the recent drops, liquidations of longs became the fuel. Almost every day, around $1 billion was burned just on long liquidations. If you look at derivatives data, the market is literally stuffed with short positions. On Binance, above the current price, there are short clusters worth billions. In the zone around $96,000 alone, there are over $2 billion in liquidations. And now the most interesting part? If Bitcoin goes to 115,000, the market will wipe out around $18 billion in short positions. For comparison, if the price drops to 76,000, liquidations would be less than $1 billion. The balance is completely uneven. It is more profitable for the market to push the price toward where more liquidity lies. And liquidity is currently in the upper zones. That's why even in the scenario where the cycle really is ending, we still have in front of us the classic structure of a big relief rally. The mechanics are always the same. First, the price moves toward the zones where shorts sit. It wipes them out, triggers an avalanche of liquidations, pushes emotions to the maximum, pulls new buyers into the market. And only then, when everyone starts believing in a new impulse, the market may make a deeper reversal. This is the maximum pain scenario that all major cycles went through, plus psychology. Today, almost everyone expects the exact same scenario, a small bounce and a strong dump downward. When the market is so unanimous, that scenario becomes the least likely, because mass expectations always become food for market makers. If the majority is preparing to short any growth, the market will go against them. Add to this the historical parallels where altcoins dropped 50% or more before big moves. Add ETF inflows, which had only 3 positive days for the entire month. This is a pure indicator of distrust and fear always creates the best entry points for big players. Add the RRP, which is almost empty, and this is what fueled Bitcoin's growth without a proper alt-season euphoria. Plus, the Fed may stop QT as early as December 1st, and that directly means less liquidity tightening. That's why the market now looks strange and paradoxical. The front end looks scary, but the back end of market structure shows that things are not so straightforward. Big players are accumulating. Shorts are sitting where it's profitable to break them. Liquidity is starting to thaw, and everyone thinks the same, which makes the current point even more interesting. Next, I would like to talk about equally important indicators that actually reflect the entire essence of the market and may help you avoid losing money here. But before that, make sure to subscribe to the channel to get even more high-quality content. Everyone is looking at the chart now and seeing the same scary pictures. Someone is pointing to a death cross, someone is drawing double tops, someone is inventing a head and shoulders, and everyone repeats the same mantra. That's it. The bull run is over. The bear market is starting. But technical analysis doesn't work the way the crowd wants it to. The death cross by itself predicts nothing. It's just a delayed reaction to the fact that the market has already been falling for some time. In this cycle, it appeared several times, and each time social networks screamed that everything was over. But after that, Bitcoin reversed and went into a new uptrend. It is not a forward-looking indicator. It is simply a reflection of what has already happened. And the most ironic part is that the death cross often appears near local lows, when the market is preparing for a bounce, not a collapse. The same goes for all other patterns. Any figure can be interpreted in different ways. On the same chart, one trader will see a flat and a crash, another will see a wedge and an upward breakout. It's a perfect playground for manipulation. The picture can always be twisted to fit the needed narrative, for fear or for greed. But the market does not move because someone drew a triangle. The market moves because liquidity changes and the price of money changes. And here's the main point. Many people now think that the drop is the magic of the cycle. The halving happened, everything pumped, time to fall. But this is not calendar magic. It's simple liquidity math. Bitcoin grew from 16,000 to 100,000 not because of new QE or a global money giveaway. It grew from the liquidity flowing out of the reverse repo. It was the system's leftover fuel. It was enough to power Bitcoin and partially the large altcoins, but definitely not enough for a full alt-season mania. The reverse repo is almost empty now. QT is still running. Rates have been too high for too long. And this is not about the cycle. It's about the fact that credit is expensive and there has been no strategic liquidity injection. That's why the market is suffocating. Not because of patterns, not because of chart figures, but because the dollar is expensive and the economy is on the edge of shifting into weakness. And now about the future. The Fed is openly discussing stopping QT starting December 1st. In the minutes they admit there is no unity inside the committee, some want to cut the rate, some want to wait. But the fact that ending QT is being discussed at all is the first signal that liquidity pressure will start to weaken. When all major economies slowly begin turning policy around, it creates a global liquidity wave that usually lifts all risk assets. This is the reason why I don't believe in the story of the bull run is over. The market does not have what is always present at the top. There is no real euphoria, no mass frenzy, no moment when every token does a 50x, no lines of new investors. On the contrary, there is complete burnout, distrust, despair, and that same feeling that it was all for nothing. Historically, this is what the zone of final fear looks like, not the final peak. Can the market go lower? Yes, it can. Can it stay in a sideways range for a while? Yes, it can. But strategically, the key remains liquidity. If rates go down and QT starts unwinding, Bitcoin will be the first to move, then Ethereum, then large altcoins, and then the lower caps. This is what forms the wave of 2026, which now looks much more realistic than the pattern battles on the charts. Friends, thank you for watching. Like the video and subscribe to the channel. Be sure to leave comments and remember that this video is not financial advice, only my view of the market. If you want to hear an analysis of your favorite coin, write it in the comments.